Welcome. We are absolutely delighted that you can join us today for this particular event we're hosting. And we are also delighted with the interest it appears to have gathered across the States. I believe we should have well over 100 people following us today, with a really good representation of alternative managers from across the US. So welcome, we're delighted you can join us. My name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in London. We are hosting this event today in part to deliver and debate the results of research we have been conducting with US alternative managers and lawyers on fund structuring overseas, but we're also doing it because we are launching our fourth publication, which is called IFI FSI. Sorry, this is sticking. We'll get there in a second, hopefully. There. This is our fourth publication, and it just launched this month. It is a monthly publication and research unit for US alternative managers who want independent and unbiased information on what to do when they're going overseas. And we are going to be distributing the publication for free for at least the next 12 months to alternative managers and advisors. And these are our other three publications, which are primarily for the European market. What we're going to be putting into FSI is, to a certain extent, a distillation of what's in those other three publications. ESG specialist publication. We are celebrating this month in September the 10th anniversary of our fund governance publication. And we have another publication which focuses upon regulatory change in Europe and Brexit and all the fun that's happened as a result of our decision to leave the EU. On the panel today, we have Lynn Correro, who's a Senior Vice President of Greyline Partners, Miles Edwards, who's General Counsel and CCO at Bruderman Brothers, and Bruderman is a specialist private equity house, you were saying, Miles, an asset manager. Deborah Francis, who's a partner at one of the leading law firms in New York, Seawood and Kissel. Wouter Plantenga, who's Head of Client Services at JTC in the US. And Cyril Schopfer, who's Director of RBC Investor and Treasury Services. So I'm going to give a short presentation of the results. I'm really going to try and fly through this very quickly. The full results will be put into the October issue of FSI, that will be the second issue. And so today we're going to, as I say, just do the headlines and then get into the debate with the panel. For me anyway, looking at what we've gathered in terms of information from the market, we've interviewed a reasonable number of alternative managers right across the US. We found them through our previous online events. We've done many of these in the last 18 months. We've also done a lot of physical events in New York over the years prior to that. And we've been doing research in the US for a very long time. So this is not new to us. So we got, I think, managers of with the combined AUM of over 50 billion right now responded, and also a very good number of the leading law firms in New York and other advisors as well. And many of those, thank you very much for responding to our research efforts. And I think a fair number of you who have responded are following us today. So we're delighted to have your response. And by the way, we will be keeping this open just for another few days. So if you haven't responded and if you'd like to contribute to any of the subjects we're about to discuss in the next few minutes, and my colleague Samantha Taylor will be in touch very shortly after this event, and we'll see whether we can include your views too. You do not have to be an expert on Mancos or anything that's going on outside the US. If you just want to give your general views, that would be great. Right, so here are the key takeaways for me, which is that US managers, from our point of view, were delighted to seem to be very interested in wanting to raise capital overseas, but their interest is strong, maybe, not that it's easy to record these things, maybe even at record levels, but their knowledge can often be weak. There are some very good advisors and law firms in the US who are there to help them, and that's how they clearly have the dissemination of knowledge has been provided to date. Another key takeaway is that Cayman is booming, but it is becoming more expensive. And that may be opening the door to places like BVI, which we haven't seen so much interest in for quite a while, and Bermuda, and indeed even directly into Delaware, and to my great surprise, Canada. Canada has been mentioned a few times as another option in the Western Hemisphere. Regarding Europe, people we've spoken to seem to think it is an opportunity, but they realize and appreciate it is very complicated, and it's become more complicated because of our decision to leave the EU. But these structures you find in the two leading jurisdictions of the EU, Dublin and Luxembourg, called MANCOs, are there to help. And we'll get into this in a second. We came across a number of managers who are using or interested, certainly know of them, and are using them. For US managers in particular, getting into Europe, reverse solicitation is absolutely critical. But that may be under threat, or it could be curtailed, and we'll get into that in a minute as well. So quickly, I'm going to fly through this as quickly as I possibly can. The results. In which jurisdictions do you or your clients, this is because we include a number of lawyers, domicile your funds or their funds. Cayman was easily the most dominant jurisdiction by a country mile. If this was in bar chart form in terms of responses, Cayman would dwarf every other jurisdiction. Luxembourg, perhaps slightly surprisingly, is second, and indeed come to be ahead of Ireland in terms of the responses we've had. I just mentioned BVI coming up on the rails. That even in terms of absolute mentions came third. Bermuda I mentioned. Jersey, Canada, we'll come on to Canada perhaps a bit later, and Guernsey. Those are all the jurisdictions in the number, ranked by the number of mentions. What type of fund structures do these managers use? Three different Cayman structures were mentioned most frequently, as they're at the top. In Europe, you have regulated AIFs, ICAVs, that's an Irish thing, and particularly in BVI, SPVs. Were also mentioned a number of times too. If you stroke your clients are launching new investment products, do you anticipate making any changes to their fund structure in the future from at present? In Cayman, no changes at all. In Europe, there do look like there will be some changes, and that's going more down the heavily regulated into the EU route, the regulated AIF. And that comes back to this question of MANCOs again, which can help a lot in that regard. And as I've already said, Delaware structures and indeed Canadian structures are in some cases being used in place of vehicles in Cayman, but not so much to really make a difference to Cayman's overall extraordinary strength. But there are alternatives that are being looked at, perhaps conceivably for the first time. If you, your clients, have funds with boards, do you, stroke they, expect to be making any changes to their composition? 37% said yes. And as one or two mentioned, I understand that it's likely, I don't know if it's definite, that on the form ADV, the SEC is going to require additional information on diversity. And I think some people are trying to get ahead of that by mentioning, yes, perhaps doing something on diversity before they're required to do it. Excuse me. Do your international investment vehicles, stroke managers, you advise, use LPACs overseas? We wanted to see whether there's any difference between the US and overseas. They are used as commonly internationally as in the US, but two advisors we interviewed made the point that they didn't think that US GPs take them perhaps as seriously overseas as they do in the US, perhaps because the LPs aren't quite as big and as powerful, I don't know, but that was mentioned on more than one occasion. This, for me, perhaps was the most interesting question in this study. What do you see as the main opportunity and the main disruptor in your overseas fund raising activities in the next 3 years? ESG was mentioned the most as an opportunity. The hedge fund guys, not surprisingly, mentioned they're licking their chops, that they expect to see a lot more market volatility coming up, and they think that's going to sort of help them with their strategy. So there's quite a lot on the managers talking about opportunities on the investment side. On the disruptor side, regulatory changes, we'll get into that in a minute, particularly in the EU. And there are changes likely or possible anyway to reverse solicitation and private placement in Europe. We were just touching upon in the seconds before, one or two people mentioned a bill that I understand is going through Congress, but apparently it's been there for a long time, reforms to carried interest. If that happens, that will be universal in the US and outside the US too. And the interest rate, the threat of interest rate rises and inflation. Here in the UK today, the Bank of England announced that it wasn't touching its 0.1% rate, even though our inflation, like everybody else's, is going up at a reasonable rate. And QE is going on just at the same exceptional, extraordinary rate as it always has been, so no change there. If regulation is a disruptor, do new EU rules like the SFDR or the cross-border distribution directive that came in August, will that impact your fundraising activity in Europe? I picked some selected quotes from what we've had so far. This was a written reply from somebody, and somebody themselves put in big in capital letters, yes, it is a big problem. And the point was made on a number of occasions by a number of people that this is requiring a reallocation of resources to non-revenue producing areas of their business because of all the regulatory malarkey that's going on. I hesitate to get into SFDR, it's amazingly complicated, but it did come up a few times by a number of people mentioning it, particularly the lawyers mentioning it. I'll very quickly say that the level 2 is mind-bogglingly complex. It was due to come in originally this March, it was postponed to January next year, it's now being postponed till July next year. I would be surprised if it's not postponed again. I think other regulators, the SEC and us here in the UK are also, the FCA are looking to see what happens with that before they decide what they do. I think the EU may have bitten off more than it can chew with level 2 SFDR. If you have EU domicile funds, do you have your own AIFM Manco or do you use a third party Manco? A lot of the managers as I've already said, to my surprise, we have asked US managers about Mancos in the past, and really, we could have been talking about something on the planet Zog. They really didn't have a clue what we were talking about. To our surprise, 47% of the managers subsample surveyed said they are aware or at least have heard of Mancos. And I think, of course, all the advisors, particularly the lawyers, are very familiar with them. And I think it's because they've been getting the word out, this is the way to go if you want to come into the EU. And that is slowly filtering out across the US market. And again, we wanted to ask whether or not people offered co-investments in the same proportion outside the US as they do inside the US. It appears that's nothing to do with geography. It depends upon the opportunity and the investor interest. And by the way, we're calling this a fund structuring trend survey because we're going to come back and do this on a regular basis in future and be fun once we've done this a number of times to see if there are changes to the results as we go along. Finally, we asked whether it's important to managers to work with a credit institution that can support their fund servicing and fund financing needs at the same time. Most people took that to be a question of bundle versus unbundled service provider solutions. The vast majority said that they're indeed, even going overseas, they're interested in an unbundled solution. However, it was made, a few people did say that when they are going overseas, they're looking at it afresh, they're happy to, and they will be willing and like to explore all options. So that is my fast ramble through the survey results. As I say, the full results will be in the October issue of FSI, and we'll hope to get a few more interviews done before we finally finish it. But that will give you a sense of what US managers think about structuring their funds when they go overseas. So I'm now going to stop sharing screen. Hooray! This has all worked so far, and I'm going to bring up the panel, and we'll get straight into the questions. Let me perhaps come to you first, Miles, with the first question I want to raise. Do you agree that US managers do want to raise capital in increasing numbers overseas, but perhaps their knowledge isn't as strong as their desire to do it? although there are some very good advisors. One of them is on the screen right next to you in Debbie. There are some very good law firms, but them themselves, they don't necessarily know an awful lot about it. Is that a fair assessment from your perspective?
Absolutely. And your survey supports that U.S. managers operate under this very traditional model: Delaware LLC or LP, onshore, offshore Cayman feeder. So everything has been really straightforward, regardless of strategy, investors, or any other consideration. So they're very comfortable working in these lightly compliance-regulated, tax-neutral jurisdictions like the BVI and Cayman. So now they're looking and saying, okay, I want to go into Europe and I want to start raising money. And they go to their advisors, and their advisors talk about MANCOs and AIFM and MiFID II and GDPR and SFDR. And they really have no idea what they're talking about. And these regulations are very complex, and they may vary between jurisdictions. So they create this barrier to entry. So U.S. managers love just basically to take what's been successful and replicate it somewhere else. So what they're thinking is, let's take what's going on in Cayman and replicate it in Europe. But then they start getting involved in what the process is. And so they step back and they say, we have to determine whether it's really economically viable for us to enter these overseas markets. So maybe the new model is somewhat of a hybrid, where they say, we want to go into Europe. We don't really want to do it completely ourselves. So maybe what we'll do is establish strategic relationships with well-established existing European asset managers. And we've seen this in August, for example. Goldman Sachs bought Dutch and Investment Partners. And you know what? That looks like a good model to have, because the benefit is you're working with somebody who's already established, who can sort of help, can be the Sherpa who navigates you through the maze of complexity, but it also gives you an opportunity to deploy your U.S. manufactured products in Europe. And of course, I think all asset managers need to look at IFI Global as a resource as well. So to answer your question, yes, but I think it's going to be eventually more of this hybrid partnering sort of situation, and then just kind of like going it alone.
Thank you. One thing I forgot to say in my introduction, I'll say it now to all of you out there. We do encourage questions as we go along. We'll try and save a few minutes at the end, just before 5 or 10 minutes before we end, to take questions as well. So please do fire in questions if you'd like to do so, and we'll try and, I see as I say that somebody's already put a question in. So we will try and take the odd one as we go along, but we'll reserve a few minutes at the end. Anybody else, before we move into other areas, do you, anybody else feel that, I said potentially, no one knows because it's difficult to measure, but potentially, perhaps because of this being this boom, particularly on the private equity side, on the alternative fund side overall, US managers are looking to raise capital overseas in conceivably record numbers. Is that correct? Do people think that is the case? What do you think?
I can maybe just jump in. And you have seen if you take Europe as an example, you have seen European alternative investment fund AUM have grown double-digit for a number of years. And investors are very happy with return provided by GP. And if you look at, as you mentioned, the first half of 2021, it looks like we are on track for a record-breaking year. So I think the interest is strong. What we have seen at RBC, historically, you have the Delaware Cayman model. I think it is evolving, and we have seen an increased number of parallel structure being launched, and ultimately then co-investing alongside Delaware and Cayman, and Luxembourg has seen a lot of that flow, captured a lot of that flow, because tick a lot of the boxes. I think to be successful and to launch in Europe, US managers need to take the time to understand the structure, to understand the operational differences, and to understand the regulatory requirement. But many US managers think it's difficult to launch a fund in Europe, but in reality, it's simpler, easier, and more efficient that it has been that they may think it is. And I think with the right partner, even a manager with little knowledge, so and back to the example we had before, there's outsource option, there's you can partner with someone else, with the right partner. Even a US manager who has little knowledge of the European environment can successfully manage a European structure, for example.
Yeah. Anybody else want to comment before we move on?
Yeah, I mean, I guess I would just add to what Cyril said. I think there is an opportunity for US managers. I think it can sometimes seem overwhelming with, as Miles mentioned, all of the different regulations, AFMD, SFDR, what do you have to do? There can be some formality differences too, even in Europe, just as far as even getting things notarized and different requirements as far as opening bank accounts that you may not have that are a little bit more complex than in the US. But I think when you get down to it, if there really is investor interest and you do think economically it's going to make sense, because I do think there is a cost benefit analysis where you're going to probably be swayed one way more towards the other. But as far as even setting up a fund in Europe, I think, when managers really will look at like kind of the core documents, if you look at whether it's a Luxembourg structure or in Ireland, there are a lot of similarities to partnership agreements that you would see in Delaware and Cayman. And so there can be a lot of familiarity that people have when you're actually doing the fund structure. I think a lot of it comes down to, what type of investment are you making? Where are the investors? Are they really looking for that, particularly if you have investors from, say, France or Germany? If there are tax concerns or you're making investments in Europe, there may be really good reasons to consider those. And then you obviously just need to think about all of the issues that you have in relation to disclosure differences in the documents, and then any marketing restrictions. We'll probably talk about that a little bit later, but each jurisdiction is going to be different, and I think that can sometimes be difficult for US managers. And again, the main consideration there, I think, is often, do we have the resources then either in-house, or are we going to outsource that? Because there can be, particularly where maybe a manager is smaller, they're starting out, they don't have a lot of in-house compliance personnel to manage not only just all of the different requirements to know how to do it, but then the filings and the reporting to the investors, and making sure that you're also not just doing that initially, but then keeping up with any changes and making sure that all of those disclosures are given, which, unless you really have a full-time compliance, person to do all of that, or you're really engaged with third parties, that can be a difficult thing for US managers, I think, to manage.
Thank you. Let's move on now to one of the more interesting areas in terms of for me anyway, in terms of the results so far, which is potential changes to fund domiciliation patterns in the Western Hemisphere. As I said in my presentation, Cayman is booming, we all know that. But it is becoming more expensive, whether it's their fault or not. It's because of the anti-money money laundering regulations and other items that are being imposed upon it from outside. It's not that they want this to happen, but they've been forced to do it. Some people have said, however, they think maybe some people have been potentially also adding, because of it really is booming, adding to their price list too, which may be outside the AML stuff. But it is, whatever the reason, it appears from the study results we've got, opening the door to other jurisdictions. I mentioned BVI is coming up on the rails in a way we haven't seen for a very long time. Bermuda was mentioned more than I expected. And this really interesting alternative just to the north of where you guys are, Canada. Who would have guessed? Debbie, can we come to you first? Were those results in any way conform with what you see doing the job you're doing, advising lots of managers out there on what to do in terms of their domiciliation right now?
Sure, I think they were. I will say I was a little bit surprised by Canada as well. I think we're not really seeing that as much. I think where I have seen Canada is if people have maybe a significant Canadian investor. So for example, some of the Canadian pension funds or even some of the Canadian banks that may be investing, there may be some tax reasons why they're more comfortable with those types of vehicles. So I would say that's probably where I've seen that. I think the other results I think were fairly similar to what I see in advising managers day to day. I think Cayman continues to be, probably the most common. I think the reason for that is, as Miles mentioned, I think people are used to it. They're, if you're just starting out, you have friends that are likely in the industry, that's where their vehicles are based. If you're coming out of a fund, maybe you've already managed a Cayman vehicle, and so you're fairly familiar with it. You feel like from a marketing perspective, investors are familiar with it, and you're not really trying to rock the boat, and you're trying to really distinguish yourself in a good way in relation to your strategy, but not really in a way that's going to give investors any pause about why they might want to make an investment in your fund. And so I think that's, inertia is a powerful force there with why Cayman, I think, continues to be so popular. I do think it obviously has gotten significantly more expensive in the past few years, including, for example, some exemptions from SEMA in relation to whether it was master fund or if you had a very small limited number of investors that have more recently gone away, and then those vehicles now needing to be audited, which can be a very big expense for the fund. And then in addition, just the SEMA fees, which are fairly significant, I think those costs have risen. So I think particularly, we talked a little bit about co-investment vehicles or vehicles that may be smaller in size. I think for those, Cayman is probably a less attractive option than it was previously, when people could maybe rely on those exemptions. There may be reasons why people are not auditing those vehicles, putting aside any other regulatory requirements you might have if you're SEC registered to audit them or things like that. But if you're not in that situation where you have to do that for other regulatory reasons, it does make it somewhat prohibitively expensive. If you're talking about a small investment of a $5-10 million, you're really going to eat up the, kind of overhead costs by having those types of fees. So I think we have seen, some more interest in BVI and Bermuda. I think, historically those had been more popular jurisdictions. So I think people are still relatively familiar with them, particularly if maybe they were at a more established manager and had seen those. And I think investors view them fairly comparably to those. I will say that I think we've seen, Luxembourg, and in some instances, probably Ireland a little bit less, although obviously with the development partnership law, which is very comparable to Delaware in a lot of ways, I think that might be something we see more of too. And I would say that's primarily been driven by investors, that if you have significant investors in Europe that are maybe concerned about some of the other offshore jurisdictions, particularly for tax reasons, I think there's been more of an interest in those types of vehicles. I will say it also does have to do a lot with where you are investing. So if you are investing, particularly in Europe or some other jurisdictions, then there may be a reason why those, Luxembourg or Ireland may be a better jurisdiction for you to consider in relation to your fund. But otherwise, I think, I continue to think that Cayman's going to be popular, but I think the fees, particularly for a new manager or for more SPV or co-investment type vehicles, there may be other alternatives that people will consider. I recently had some clients, even though they're going to have non-US investors, decide to go ahead with a Delaware fund for those types of co-investment or SPV vehicles. Non-US people, even though it's not as common, can invest in US funds. They will obviously get a K1, which sometimes non-US investors are a little bit concerned about because they view themselves as maybe being on the IRS's radar. I think there's been a number of non-US investors that have gotten more comfortable with that over the years. And as long as there's no real tax reasons why in relation to a particular investment, they couldn't participate through the Delaware entity, I think that has become an option as well, particularly because Delaware is obviously significantly less expensive, at least in relation to fees and ongoing costs. There's no then requirement that you get an audit, for example, under Delaware law or things like that. So it does tend to make things a little bit easier.
Thanks. Can I come to both Cyril and Wouter on that? What's your view on domiciliation in the Western Hemisphere? Do you notice any changes?
Yeah,
Yeah,
I think I'm in the. I think for what the audience is hearing, I think coming back to the aspect of looking at it from an investor perspective, because at the end of the day, these structures are meant to be to give access to investors coming into the fund. So what a lot of the conversations we're having with first-time managers looking, whether it's to Europe or other parts of the world, is really to kind of figure out, okay, who are you actually targeting? Who's going to be your investor base? Who's going to be your counterpart? Because it's not always the case that you as a manager can dictate, the fund structure yourself or choose the domiciliation. It's actually the other way around. In most cases, if you're looking at certain jurisdictions like Germany or France or other jurisdictions, institutional investors will, almost dictate that entry point into your fund. So I think that, I'm not surprised for that reason that Cayman and Luxembourg are still the dominant jurisdictions. Another element of distinction there is to really look at, okay, are we dealing here with the US managers being open-ended hedge funds, or are we dealing here with private equity real estate funds? There's a clear distinction between choice of jurisdiction between the two. And that's, kind of mixes itself with jurisdictions like Luxembourg, who have a very, comprehensive legal system and framework with unregulated fund vehicles and LP types of structures, where, closed-ended managers can benefit from. Whilst the Irish model may be more geared to the UCITS platform. So I think, having that conversation at first with experts in the field and your advisors is really what you should be thinking of, to really kind of, okay, what are we looking at? What's our investor base going to look like? What is our strategy? That will dictate a lot, other than just choosing a jurisdiction, because that's not how it works.
Thanks. And Cyril, you got any views on that?
Yeah, no, that's very aligned with what Walter just mentioned. And I think, these two drivers, when you look at alternative jurisdictions, one is manager want to access new source of capital. Let's take, for example, the European passport. And number two, which is the prominent driver, is the investor demand, right? Investor demand, when the investor is big enough to basically drive the setup, for example, of a Luxembourg structure. And I think there has been a strong investor demand for a structure that provide better investor protection. And in some country, depending on the segment and the type of investor, there is even a requirement to demonstrate that they invest in those type of structure, i.e., for instance, AFMD compliance. So we have seen a sustained flow towards those type of structure. I think Ireland, that has been mentioned with the amendment of the Irish Investment Limited Partnership Act, will play a bigger role. Historically, that has been very liquid alternative on UCITS in Ireland. I think now it gave them a level playing field with Delaware, Cayman, Luxembourg. So we could see some of that flow going to Ireland in the future. And I would also like to mention the Channel Islands. Because Jersey, Guernsey, I think have an important role to play going forward. They have a fast, efficient, and commercially minded environment. Of course, they are not in the EU, but they are a third-party country and can provide access to European investors through a local private placement regime. Canada, finally, just to comment on Canada, we have seen some manager launching fund through Alberta or Ontario, but I wouldn't say it's a trend, right? I think it's a limited example of that, and that remain on an ad hoc basis as opposed to seeing a trend towards Canada.
Okay, well, this is why we're going to do this on a very regular. I don't know exactly how frequently, but we're definitely going to come back and ask them on some sort of regularity and see whether, in 6 months' time or whatever it may be, it's changed. Though I want to get on to Europe, which we haven't really discussed much. Before I do, there's one particular question I noticed that's come in. I said we'll try and take a few questions as we go along. We'll save a few minutes at the end for the other ones we haven't taken. But it also touches upon perhaps some of the points you were just making, particularly you, Wouter. Where did I see this question? Hang on a second. Oh, yes, here we are. If some domiciles are better for certain investor categories over others, what should we do if we want to attract investors from different categories? We're not going to register funds in more than one place. I imagine that's a manager in somewhere in the US that's filed that question is. What's the simple, quick answer to that? I mean, no, it may be your point about, different jurisdictions with different categories of investors, fair enough, but people aren't going to go flying around the world, launching funds in every jurisdiction for every different type of investor. So what should they do?
Well, I think in the European context, and I think we'll get there in the presentation too, is this is the whole discussion around AFMD. You know, if you want to benefit from a marketing passport and get to market your fund in Europe, you know, that's the way to go. I think that if, you know, coming back to the argument, okay, again, which fund domicile is relevant, you know, again, if there's multiple jurisdictions involved, that's when, particularly in Europe again, that's when that question becomes relevant. Because if you are going to go to one or two jurisdictions, you may not need that heavy lift of a regulated environment, you know, of a fund, and you may actually decide to have a light touch jurisdiction with a national private placement type of approach. But I think that, again, coming back to the European side, that's really where the relevance of the discussion around AFMD and how do you market yourself with a passport becomes relevant. And that's, you know, part of the discussion we're having with clients is, okay, if that's what you're going to decide to do, you know, what does that mean? You know, which elements of, you know, the structure will you have to take into account? Because that is an upgrade, and it's a different environment you enter into, because then the Manco becomes relevant and the depository becomes relevant, and that's a whole different dialogue to have. So I think that is kind of a short answer to the question, I guess, but for others to chime into, because I know we've been talking about this before.
Okay.
Yeah,
well,
I mean,
sorry, Lynn, go on.
No,
sorry,
no,
Lynn.
I was just going to say, I think that's what the questioner had a very valid point, which is, you know, kind of under this new regime, you need to have a pretty targeted marketing approach or idea of who you want to be working with, because the kind of scattershot, you know, let's just go around the world and talk to whoever we can talk to and bring them into our fund, you know, that just, it doesn't work for investors anymore, and particularly under the regulations. And
Right.
kind of going back to what Deborah was saying, you know, with Bermuda, they've had the reinsurance industry for a very long time. That was a much smaller industry, maybe a little bit more niche than your typical hedge funds, private equity, real estate. But that industry has gotten bigger. Bermuda has gotten more advanced in their regulatory oversight, but they still don't kind of have the same reputational issues, perhaps, as Cayman does with certain segments of the market. You know, the tax haven, kind of what we were talking about earlier. But I think, you know, if you're going to go into Europe, you really need to understand who you're looking for and, you know, where they are. You really can't say, we want to sign up and you know, register across, you know, 53 member states, because managing that from a compliance standpoint is just impossible.
Well, that's a very good segue into where I want to go next, which is exactly Europe. As I said in my introduction, and this was a very common type of response to sum it up, a lot of people see Europe as a potential opportunity, because there is a lot of money in a lot of places in Europe, but it is very complicated, and it's only becoming more complicated. And Brexit is not a one-off event, it's probably a 10-year process, and we're probably not even halfway through it. And we are, here in the UK, diverging from the EU rule book, and that's going to mean potentially parallel fund structures in Europe. But then the second biggest market for alternatives in Europe is Switzerland. That's also outside the EU as well. So Cyril, can I come to you? Do you agree that Europe is an opportunity for many American managers, but that it is complicated? And do you think for a lot of them, these, I've already mentioned a couple of times, Mancos, particularly third-party Mancos, is the way to go? I thought you'd be a good person to ask, because RBC doesn't have one. Am I right in saying? Many service providers do, but you guys, you can be objective on this.
Yeah, so I would say first, URPS offers alternative investment manager with attractive fundraising opportunities. I don't think it's complicated. I think it's critical to find the right partner to support the offshore venture, or to support the setup of the European platform, to get the right local fund lawyer, to have the right auditor and the right depository, but also if you decide, or the US manager decide to outsource the alternative investment fund manager function, the right AIFM. What we are seeing here at RBC is typically US manager coming to Europe. They will go the outsource model, right? They will select an independent AIFM who will provide the required services. And I think it's a good model because it means you work with a partner that has this local expertise from the outset. And some manager decide or have the intention, at least at the beginning, to bring it in-house of a longer term. Some do it and some never get to that stage and keep it outsourced. We don't provide AIFM services, that's right, but you will not find any of the credit institution bank providing those type of services. We see it as a conflict of interest with the other function that we will be performing. I think the other option is obviously to bring it in-house to launch. I should also add the typical model you will see for US manager is you appoint an alternative investment fund manager in Europe. They will typically keep the risk management function in-house, and the investment management function will typically be outsourced back to the US asset manager. The other option is to set it up in-house. But there's a cost, obviously, like anything else. There's a requirement, obviously, to prepare an application for authorization with the local regulator, and to demonstrate local substance that will support the required framework in terms of risk, governance, compliance, as per the directive. And then last year, we'll just briefly comment on Brexit. You have mentioned Brexit. I think existing US managers that were in Europe before Brexit typically set up in the UK, had a UK-based AIFM. They haven't waited, our client, they haven't waited to get clarity on Brexit to implement their contingency plan, which means really moving the AIFM in a EU jurisdiction, typically Ireland or Luxembourg or somewhere else in Europe. A new manager coming from the US, coming to Europe, I think Brexit has less of an impact because they're going to come here now and will set up a model that is Brexit proofed, so to say.
All right.
Yeah,
Well,
I
let's-
think we're
Sorry, go ahead.
looking. Sorry, I was going to say just on the Manco point, I think Cyril raises a really good point. You know, you can try to do this in-house, but there's so many moving parts. If you go that third-party Manco route, then you do kind of put that backbone behind you. And I think I just want to mention that there isn't a one-size-fits-all. I mean, you know, if you're Fidelity and you want to go to Europe, I mean, you can go to Europe and do it yourself. Your resources are endless. You don't need a Manco. You know, you can do that. If you're, you know, a smaller firm, 10 employees, you know, new to this space, you know, I hear a lot about the expense associated with the Mancos and that kind of a thing, but from the standpoint of kind of having somebody put up those guardrails around you, you could potentially lose a lot more money to the European regulators or litigation than you would ever pay in a service fee to someone to help you stay in those rails so that you don't have those things happen to you. But that also leads to the point of, you know, in the UK right now, there's a lot of focus on that appointed representative model, which is somewhat similar to the Manco models. And so I think, you know, if you are a new manager looking to go into that jurisdiction, you want to make sure that you understand what the responsibilities are going to be of the AIFM and what your responsibilities are going to be. Also make sure that they know what they're doing and they're actually conducting the oversight appropriately. Because, you know, the last thing you want to do is, you know, look at this as an opportunity to expand your business and find yourself associated with an entity that, really is just asset gathering and not actually providing the services to you that you think you're getting. The other aspect of it is that, tax liability, there's all these different thoughts. Marketing and understanding marketing is going to be crucial. And I think the Mancos, to Walter's point earlier, are going to help you with that, because they'll be able to take you to Poland, to Bulgaria, to, whereas if you're trying to do all of that on an NPPR basis, what someone defines as marketing and what someone defines as reverse solicitation can broadly differ across all the individual member states. So I think it's a good solution in certain options. It certainly can be done on your own, but don't underestimate the compliance, legal, and administrative stress it could place on you, not to mention just the reputational risk of getting in trouble over there for something simple you could avoid.
Yeah, maybe if I can, Simon, add to that a little bit, because that's where managers sometimes view the world as, when they enter Europe, one of the perceptions they have is the landscape of service providers. They're dealing with law firms, banks, with different service providers, and that's not an easy task to navigate that. And honestly, I think from the model coming from the US, they will feel in our space, for instance, that the fund administrator would be the typical starting point. We see that changing a little bit because of the AIFM or the Manco position as being effectively the most important part of the puzzle. That's really where you should be focusing on, because that is your flagship operation, marketing your fund. Those are the people who actually understand the landscape. The remainder of your infrastructure is generally, I wouldn't say commoditized, but it has that kind of replicative model behind it. But the Manco or the independence of the Manco is really important, because that will dictate your success. That will dictate, how you're going to perform and how you're also going to attract your investors. And I think, if you ask me for a quick tip for managers, is saying, okay, if you're doing that whole research, focus your energy on that AIFM, on that Manco, and start to understand the people behind it, what their strategies are and where they're good at. I think that's a really important thing.
Thank you. We've only got basically 10 minutes to go. I do want to get to some of the questions that are there. There were two areas we haven't yet touched upon. Maybe we can do this very quickly and then go to the questions. One of them, we were going to talk about ESG, and then also Lynn just half touched upon reverse solicitation already there. But Wouter, I know you wanted to raise ESG, which did come up as the biggest opportunity people see. I don't know when people said that in the research exactly what they meant. Is that because they've been re-engineering funds and putting ESG labels on them and doing a lot of fantastic capital raising? Maybe that's all it is. I don't know. Do you want to comment on that?
Yeah, I think, there's a lot in the mix of when you talk about the ESG, and maybe two things. It's obviously the European environment, which has been very matured around ESG and the model. So if you're talking about investors, responding to that, inherently, US managers will be exposed to that, because they'll be asked about, had the ESG framework within they operate, whether it's their own infrastructure or it's their investment strategy. The other thing is, I think, with ESG, I think the interesting part, what I find is just, it's a convergence between regulation and data, because, part of it sits with the fact, okay, you have to be ESG compliant, and there's a lot in the mix there too, in terms of what does that mean. But, more and more so investors taking it more the approach of, okay, what is my ESG exposure? How do I get to, the data points within the manager? So there's, from an infrastructure perspective, managers really have to figure out now a model of, okay, how do I become for my investors, kind of in general terms, ESG compliance, and whether or not that replicates itself to my legal documents or my investment strategy. But also, how do I facilitate the ask from investors much more on the ESG side in terms of data gathering? Do I have enough data I can push back to investors, to really satisfy their data needs? So we can talk about ESG for a long, long time, and I think there's it's a very impressive and an interesting environment, which is now converging into two sides of the world, trying to figure out what that means for one another. But at the end of the day, it's here to stay. And at the end of the day, I think it's something which US managers will have to keep in mind, you know, when dealing with Europe in particular, that this is a big ask for investors and they have to deliver on it.
Okay, I'm going to try and get at least 2 of these questions in before we finish. So we'll be, if you don't mind, relatively brief answers, and 2 very different questions. One of them is we haven't talked about at all, although there was a question in the research on fund governance. Somebody's asked, how much interest do investors have in who is on the boards of funds? We get conflicting advice on this. Is that a good one for you, Miles? Do you want to?
Yeah, I mean, if we remember the Waverly case a few years ago in Cayman, there's a lot of scrutiny put on directors and the number of boards they sat on. And the Cayman government basically, you know, looked at it and really did nothing. So if we bring us back forward, we basically have that situation where in some cases, there's a whole cottage industry in the Caribbean based on providing directors to funds. And sometimes we don't find a lot of information about them. I haven't been in situations where anyone has asked me about directors of offshore funds. And maybe
you have, sorry, you have or haven't?
I have not.
So it's not that guy's a question. It's not that
asked me
right
about it. But what I do see is I see more information about these directors appearing in confidential offering memorandums, so on and so forth. And because now the SEC requires really increased scrutiny on the due diligence that we need to do on directors and service providers, I think more information is going to come about. But I've never been in a situation where an investor either has questioned a director or chose not to invest in a fund because of that specific director.
That's interesting.
One point I would like to make, though, is that I have had clients subject to SEC examination where the SEC actually interviewed an independent director. And one of the things that they were looking at was how many funds that director sat on, what involvement did the director actually have? Like, are we just on the filings and rubber stamping things? You know, if you're sitting on 120 boards, how do you make sure that you're actually undertaking your governance and not just being, a shill for the manager? So there were, if investors aren't asking, that's one thing, but I can say the SEC definitely is. So you would want to
including
look at
funds overseas, including funds in other jurisdictions like Cayman, or just in the US?
No, these were all the offshore funds by US managers. Because
very interesting.
I've seen that as
Waverly
well.
all over again.
Yeah, Deborah, you've seen it as well with your clients.
Yeah, I've seen that as well. I have seen, I think I've seen the SEC ask information about the directors and sometimes interview them, or want to get some information. And then I have seen particularly large non-US investors ask questions about board composition. I think it's come up, particularly in the case of sometimes where people have a Cayman master fund that's an LP where there is no board at maybe the master fund level. Sometimes investors will say, well, you should put in some kind of similar advisory board context there to have oversight, particularly at the master fund, right? That's where you're doing the investing. That's where you have really the substantive audit and not just have one at the feeder. And I think I have heard from clients too that sometimes institutional investors, even some investors in the US as well will want to speak with directors when they're doing due diligence. And I think they ask a lot of the similar questions that Lynn was mentioning: how many boards you're on, what is your real involvement, do you have any involvement, how many board meetings are there a year? And I think those are some things that I think have gotten a little bit more formal. I think before people would do maybe the annual visit, the Cayman directors would come up, you'd have, kind of lunch, you'd talk about some things, you'd call it a board meeting, and that would be it. I think now there is more involvement because I think investors and regulators are a little bit more focused on that oversight, because ultimately the board does have a lot of control over those types of mechanisms, whether it's suspensions, whether it's conflicts. There's a lot that they do have control over. Yeah, in theory, I think, but they could exercise that. And I think people are a little bit more focused on that.
And I think, Simon, shout out to the fund governance thing that you all put together. And I had done that panel with IFI as well, in full disclosure. But that was, if you're looking to go outside of the US, I think US investors are used to looking to the manager, and they're not as concerned about the fund boards and things like that, because they sort of look at the manager as being the actual power in that situation. But what your survey found out, and what we talked about on that panel, was the idea that for European investors, fund governance actually is a much more concerning, substantive area to dig into than for traditional US investors.
Sorry, I'm going to be very brutal. We've got literally 4 minutes. I'm going to try, these other questions have been anonymous. Can we just give, because I would love a minute at the very end, so can we try and do this in 2 minutes? Somebody called Benjamin Lamping has asked this question. If you can do very short, pithy replies, a couple of you. What do members of the panel think are best placed to help US managers assess the opportunity for capital raising in other regions, Mancos and Europe legal counsel administrators? Do these firms have deep enough insight into investor requirements to make such judgments? Is the future of such market testing data-driven? Thank you, Benjamin Lamping, whoever you may be. That's a very interesting question. And we're not going to give it really any justice, because I'm going to ask for a seconds replies. Anyone want to answer that? Cyril, we talked about capital raising in our prep stuff. Anyone else want to have a go at that very quickly?
Yeah, I think, Simon, maybe, the placement agent role is important here. Not to go too deep into that discussion, but that's usually where this conversation starts as well. So I'll stop right there.
Anybody else?
I think Cap Intro with your prime brokers, they usually have good teams that can help you with that.
Okay, well, listen, I want to thank everyone very much for attending, but I particularly want to thank RBC and JTC for sponsoring the research we've been doing, and also this event today, and also Greyline being great at getting the word out to their clients at this event too. Thank you, panel. Thank you, all of you who've stuck throughout the hour of this discussion. As I said at the very beginning, this is the start of something very new for us. We're coming more to the US, God willing. Now the US government has lifted the travel ban. We'll be doing physical events. You decide to let us dirty foreigners back into the country. Thank you very much for that. So I don't know whether we'll be able to do physical events this year, but we absolutely will be back at our favorite place, which is the Cornell Club in Midtown Manhattan. We'll carry on doing them there, but we'll also be doing tons upon tons of online events and more research now that we have this US publication. We will be doing some event probably in a month's time. Won't be research around it. We will be doing more research on a quarterly basis. So we're going to put our thinking caps on. We'll be delighted to hear from anybody who has any thoughts on where we could go with our research and topics for the next one of these. But we're coming your way, America. We look forward to hopefully seeing you in person as well as in this crazy online format. Thank you all for your participation, and hopefully see you next month. Bye-bye, everybody.
Thank you.
Thank you.
Thank you.
Bye.
Bye.